On October 31, 2025, banks borrowed $50.35 billion from the Federal Reserve in a single day. That's the highest emergency borrowing from the standing repo facility since it was created in 2021. And here's what makes this terrifying. You didn't hear about it on the news. The banks didn't tell their depositors. The financial media barely mentioned it. This was a quiet, behind-the-scenes scramble for cash that reveals something profoundly broken in the banking system. When banks need to borrow $50.35 billion overnight, they're not managing normal operations. They're fighting for survival. Let me put that number in perspective. During the September 2019 repo crisis that nearly broke the financial system, the Fed had to inject $75 billion over 3 days to prevent a complete meltdown. This time, banks took $50.35 billion in just 24 hours. And unlike 2019, when the spike was sudden and temporary, this borrowing spike happened after weeks of elevated stress. By the time you read this, that number has likely grown larger. But here's what nobody's talking about. Within days of that record borrowing, the president of the New York Federal Reserve held a secret emergency meeting with Wall Street banks. According to the Financial Times, John Williams convened senior executives from major financial institutions to discuss the short-term lending facility. The Fed doesn't call emergency meetings to celebrate good news. They call them when something is breaking. What comes next is what should terrify you. This isn't the beginning of the crisis. It's the warning light flashing red before the engine explodes. Let me show you exactly why this emergency borrowing reveals a banking system on the edge of collapse, why the Fed can't stop what's coming, and how the theft of your wealth has already begun. To understand why $50.35 billion in emergency borrowing signals catastrophe, you need to understand what the standing repo facility actually is and why banks use it. The repo market is the plumbing of the financial system. It's where banks and financial institutions go to borrow cash overnight by pledging treasury bonds and mortgage securities as collateral. Think of it like a pawn shop for banks. You bring in your treasury bonds worth $100 million, and the lender gives you $98 million in cash overnight. The next day, you pay back the $98 million plus a small interest fee, and you get your bonds back. This happens every single night in the financial system. Banks use it to meet cash requirements, balance their books, and ensure they have enough liquidity to operate. In a healthy market, banks borrow from each other through what's called the private repo market. Bank A has extra cash, Bank B needs cash, they agree on a rate, and the transaction happens between them. The Federal Reserve stays out of it. But when something breaks in the system, when banks stop trusting each other, or when there isn't enough cash to go around, the private market seizes up. That's when banks turn to the Fed's standing repo facility. The SRF was created in July 2021 as a permanent backstop after the September 2019 repo crisis exposed how fragile the overnight lending market had become. It's supposed to be a safety valve that banks only use during quarter-end reporting periods or when there's temporary stress. The rate is currently 4%, which is expensive compared to what banks can typically get in the private market. Banks don't want to use the SRF because it costs more and because it signals to regulators and other banks that you're having trouble. But here's where it gets dangerous. When banks borrowed $50.35 billion from the SRF on October 31, 2025, they weren't using it as a temporary convenience. They were using it because they had no choice. The private repo market wasn't providing enough cash at reasonable rates. Some overnight repo rates had spiked above the SRF rate, meaning banks were so desperate for cash they were willing to pay more than 4% just to get it. That's not normal. That's a sign of severe liquidity stress. Let me show you the exact mechanism of what's happening. Since June 2022, the Federal Reserve has been engaged in quantitative tightening. That means they've been draining approximately $2.19 trillion in reserves from the banking system. Total bank reserves have fallen from over $4.2 trillion at the peak in 2021 to under $3 trillion in 2025. As reserves decline, there's less cash sloshing around the system for banks to borrow from each other. The Fed calls this maintaining an ample level of reserves, but what they actually mean is they're walking a tightrope, trying to keep just enough liquidity in the system without flooding it again. The problem is they've miscalculated, they've drained too much, and now banks are scrambling for cash that isn't there. The $50.35 billion in emergency borrowing is the evidence. The secret emergency meeting is the confirmation. Something is breaking. Let me show you what happened in September 2019 when the repo market last broke this badly. It's a pattern you need to recognize because it's happening again right now, only larger and more dangerous. On September 16, 2019, the overnight repo rate suddenly spiked from approximately 2.43% to 5.25%. During intraday trading, some rates hit 10%. Banks and hedge funds that needed to borrow cash overnight were facing interest costs 4 times higher than the day before. The secured overnight financing rate, which tracks repo market conditions, jumped 282 basis points in a single day. This wasn't supposed to be possible in a stable financial system. What caused it? 2 simultaneous events drained cash from the banking system. First, corporate tax payments were due on September 16th, pulling approximately $100 billion out of bank reserves as companies transferred money to the Treasury. Second, the Treasury Department had just auctioned $78 billion in new government bonds the week before, which absorbed cash from the financial system as dealers paid for those securities. Together, these events reduced the pool of available overnight lending cash just enough to break the market. But here's what you need to understand. The total amount of reserves in the banking system in September 2019 was approximately $1.4 trillion. That seems like plenty. But it wasn't distributed evenly. The 4 largest banks held a disproportionate share, and they weren't willing to lend it out. Smaller banks and hedge funds that needed overnight cash found themselves bidding against each other, driving rates to emergency levels. The Federal Reserve panicked. On September 17th, they announced an emergency repo operation offering to lend $75 billion overnight to eligible institutions. They continued these emergency operations for days, eventually committing to provide $60 billion per night through October and purchasing $60 billion in Treasury bills per month to inject more permanent reserves into the system. The total intervention exceeded $400 billion over the following months. The crisis subsided, but it exposed a fundamental fragility. The banking system requires approximately $1.5 trillion in reserves to function smoothly, but nobody knows the exact number. The Fed had been reducing reserves through quantitative tightening after the 2008 crisis, slowly draining liquidity. They pushed too far, crossed an invisible line, and the overnight lending market seized up. It took massive emergency intervention to restore stability. Now compare that crisis to today. In September 2019, reserves stood at $1.4 trillion and a $100 billion cash drain broke the market. Today, reserves have been reduced to under $3 trillion after the Fed drained $2.19 trillion since June 2022. That sounds like more, but it's not when you account for inflation and the massive expansion of bank balance sheets since 2019. In real terms, adjusted for the size of the financial system, reserves are tighter today than they were then. And there's a critical difference. In 2019, the crisis was triggered by predictable events, tax payments, and bond auctions. Everyone knew those were coming. The system broke anyway. Today's stress is happening without any major scheduled events. There are no massive tax payments due. There's no Treasury auction crisis. The market is simply running out of cash on its own because the Fed has drained too much liquidity and banks are hoarding what remains. When banks borrowed $50.35 billion from the standing repo facility on October 31st, they were sending the same distress signal that repo rates at 10% sent in September 2019. The difference is the scale. The 2019 crisis required $75 billion over 3 days. This one hit $50.35 billion in 24 hours, and it's not over. According to Wolf Street, usage of the SRF has remained elevated, with additional spikes in the days following. The pressure isn't releasing, it's building. Today, in November 2025, the overnight repo market stands at a breaking point that makes September 2019 look like a practice run. Let me show you the exact numbers and why this time is catastrophically different. The standing repo facility hit $50.35 billion in usage on October 31st, 2025. That's the highest borrowing since the facility opened in July 2021. To put that in perspective, typical daily usage of the SRF ranges between $0 and $5 billion. Even during quarter-end reporting periods, when banks face temporary liquidity pressures, usage rarely exceeds $15 billion. On October 31st, banks borrowed more than 3 times the previous record. By November 2nd, usage had dropped to $29.4 billion, but that's still 6 times the normal level. This isn't a one-day spike, this is sustained stress. Here's what you need to understand about who's borrowing and why. The standing repo facility is available to primary dealers, which include the largest Wall Street banks and securities firms. These are institutions like J.P. Morgan Chase, Goldman Sachs, Bank of America, Citigroup, and major foreign bank branches operating in the United States. The Fed doesn't disclose which specific institutions are borrowing, but the scale of the borrowing tells you it's not 1 or 2 small players having a bad day. This is widespread demand across multiple large institutions. The concentration of risk is what makes this dangerous. According to Federal Reserve data, the 4 largest U.S. banks hold approximately 45% of all banking system assets. These same banks dominate the repo market, both as borrowers and lenders. When they simultaneously need to borrow $50.35 billion from the Fed, it means they're not lending to each other. That's bank-to-bank trust breaking down. Let me show you what's happening beneath the surface. Since the Fed began quantitative tightening in June 2022, they've reduced their balance sheet by $2.19 trillion, bringing it down from approximately $9 trillion to $7.4 trillion as of late 2024. This drainage didn't come from nowhere. It came directly from bank reserves and the reverse repo facility, where money market funds park cash overnight. The reverse repo facility, which held over $2.5 trillion at its peak in 2022, has now declined to approximately $200 billion. That drainage is nearly complete. Now the pressure is falling entirely on bank reserves, which have dropped to approximately $3 trillion. But here's the critical problem. Not all reserves are usable. Banks must hold reserves against their deposits and meet regulatory requirements. The amount of truly available reserves, the cash that banks can actually deploy into the overnight lending market, is far smaller than $3 trillion. Estimates suggest the effective floor is somewhere between $2.5 trillion and $2.8 trillion, depending on the distribution of reserves across banks. We're approaching that floor right now, and the Fed is still running quantitative tightening, draining approximately $25 billion per month in treasuries and additional billions in mortgage-backed securities. Every month, the pool of available overnight lending cash shrinks further. The market is running dry. This creates a vicious cycle. As reserves become scarce, banks hoard what they have. They stop lending to each other at normal rates because they might need that cash themselves. This reduces the supply of overnight lending, which drives rates higher. Higher rates stress other parts of the system, particularly hedge funds and leveraged financial institutions that depend on cheap overnight borrowing. As stress increases, banks hoard even more, tightening the spiral. The $50.35 billion in SRF borrowing is the market screaming that we've hit the breaking point. Banks are paying 4% to the Fed rather than lending to each other at 3.8% because they can't find cash in the private market at any price. Some private repo rates spiked above 4.5% on October 31st, according to market data. That's not a functioning market, that's a market in crisis. And there's no hedge that actually works. Banks tell regulators they have sufficient liquidity buffers and access to Federal Reserve lending facilities. But those facilities require collateral, specifically high-quality bonds. If bond prices are falling at the same time that liquidity stress is rising, which is exactly what happens during financial crises, banks face simultaneous losses on their bond portfolios and increased collateral requirements to access emergency lending. The supposed safety net tears open under stress. This is roughly 35 times larger than normal SRF usage, happening without any crisis trigger, in a market that still has months of further reserve drainage scheduled. The Fed has walked us to the edge of the cliff, and now they're pretending everything is fine. Let me give you a specific example of how this repo market stress will destroy your financial stability without you ever knowing what hit you. You're 38 years old in November 2025. You're making $78,000 per year at a mid-level corporate job. You've been saving diligently, putting away $800 per month into a high-yield savings account that's paying 4.5% interest. You currently have $42,000 saved. Your goal is to have $60,000 for a down payment on a house by mid-2026. At your current savings rate plus interest, you're on track to reach that goal in about 18 months. You feel financially responsible, you're doing everything right. Then the repo market breaks in March 2026. It starts with another spike in emergency borrowing from the Fed. This time, $50 billion isn't enough. Usage hits $80 billion, then $120 billion over a single week. The Fed announces emergency lending facilities. Within 72 hours, 3 mid-sized banks that relied heavily on overnight repo funding can't roll over their short-term debt. They fail. The FDIC steps in and arranges mergers. Your bank, where you keep that $42,000 in savings, isn't one of the failing banks, but the broader crisis triggers a flight to safety. Depositors pull money from smaller regional banks and move it to the 4 mega banks they perceive as too big to fail. Your bank loses 18% of its deposits in 2 weeks. To prevent a run, they freeze withdrawal limits above $5,000 per day and suspend online transfers to other banks. You can't access your full $42,000 to make your house down payment. You can withdraw $5,000 per day, which means it would take 9 days to get your own money out. But the house you were trying to buy is sold to a cash buyer within 48 hours. You lose the deal. 6 months later, by September 2026, you've managed to stabilize. You moved your money to a larger bank. You've saved an additional $5,800, bringing your total to $47,800. But here's what happened to the housing market during those 6 months of financial crisis. The Fed slashed interest rates back to near zero to contain the banking panic. Mortgage rates dropped from 6.5% to 3.2%. That cheaper money flooded into housing. The house you were trying to buy for $320,000 is now listed at $385,000. Other homes in your target area increased 18 to 22%. You saved $5,800 more, but you're now $65,000 further from your goal. You went from 70% of the way to your down payment to 52%. 6 months of crisis erased 2 years of progress. Meanwhile, someone who owned $320,000 in residential real estate in early 2026 now owns assets worth $385,000. They gained $65,000 without doing anything except surviving the crisis with assets instead of savings. This is the wealth extraction mechanism built into the system. The crisis transfers wealth from savers to asset holders. And it's triggered by something you've never heard of, the overnight repo market running out of cash. Now, let me show you the triggers that will cause this repo crisis to spiral into a full banking emergency. They're already appearing, and several will likely activate over the next 12 to 18 months. The most obvious trigger is continued quantitative tightening, draining reserves below the breaking point. The Fed is currently reducing its balance sheet by approximately $25 billion per month in treasuries. At that pace, they'll remove another $300 billion in reserves over the next 12 months. According to analysis from the Cleveland Federal Reserve, the floor for ample reserves is somewhere between $2.5 trillion and $2.8 trillion, depending on distribution across banks. We're already at approximately $3 trillion. That means we have at most $200 billion to $500 billion in cushion. At $25 billion per month, that cushion disappears in 8 to 20 months. When reserves cross that invisible threshold, the overnight market will seize up completely, just like September 2019, but without enough reserves remaining to absorb the shock. The second major trigger is Treasury issuance overwhelming dealer capacity, the U.S. Government is running a deficit of $1.78 trillion in fiscal year 2025, approximately 5.9% of GDP. To finance that deficit, the Treasury Department must auction approximately $1.5 trillion in net new debt this year, plus trillions more to roll over maturing securities. Total Treasury issuance in 2025 is projected to exceed $7 trillion. Those bonds are bought by primary dealers who finance their purchases in the overnight repo market. When dealers take down a $50 billion Treasury auction, they need to borrow $50 billion in the repo market to pay for those bonds until they sell them to end buyers. As deficits remain elevated and Treasury supply stays heavy, dealer financing needs keep growing. Each new auction absorbs more overnight cash from the repo market, tightening the system further. When a particularly large auction coincides with already tight reserve conditions, the market breaks. Corporate tax payments and quarter-end effects represent perhaps the most dangerous trigger because they're predictable but unavoidable. Every quarter, particularly in March, June, September, and December, banks face simultaneous pressures from quarter-end regulatory reporting and large corporate cash movements. In March 2026, these seasonal pressures will hit a banking system already stretched thin by low reserves. The September 2019 crisis was triggered by a corporate tax payment of approximately $100 billion combined with Treasury auctions. The same seasonal forces exist today, except reserves are tighter and the banking system is more fragile. March, June, and September 2026 are all high-risk periods. Here's what you need to understand about how these triggers interact. When reserves hit the floor and overnight borrowing stress increases, it doesn't stay contained in the repo market. Higher overnight rates increase borrowing costs for hedge funds, mortgage REITs, and leveraged financial institutions. Some of them are borrowing hundreds of billions short-term and investing in longer-term assets. When their borrowing costs spike from 3.5% to 6% overnight, their business models break. They're forced to sell assets to reduce leverage. Those asset sales push down bond prices, which triggers margin calls on other leveraged positions, which forces more selling. That cascade can happen in 48 to 72 hours. The specific trigger almost doesn't matter at this point because the system is so fragile. It could be quantitative tightening crossing the reserve floor in summer 2026. It could be a large Treasury auction in spring 2026 coinciding with corporate tax payments. It could be a hedge fund failure that cascades into broader selling. What matters is the underlying fragility. The $50.35 billion in emergency Fed borrowing in October 2025 is the warning. The system is already breaking under normal conditions. When an actual shock hits, there's no cushion left to absorb it. The timeline is 12 to 18 months at most. By mid to late 2026, one of these triggers will activate, and the cascade begins. Now, here's what you need to understand. When the repo market fails this time and takes the banking system down with it, there's no bailout large enough to contain it. In 2008, governments and central banks committed approximately $12 trillion globally to stabilize the financial system through guarantees, asset purchases, and lending facilities. The U.S. Federal Reserve alone expanded its balance sheet from $900 billion to $4.5 trillion over several years, purchasing toxic mortgage-backed securities and flooding banks with reserves. That intervention represented roughly 100% of U.S. GDP at the time. It was the largest financial rescue in human history, and it barely worked. The overnight repo market today involves approximately $4 trillion in daily transactions. That's not the total at risk. That's just the daily volume. The broader short-term funding markets that depend on repo as the foundation total approximately $10 trillion to $12 trillion when you include commercial paper, treasury bills, money market funds, and short-term bank debt. If the repo market seizes up for more than a few days, all of those connected markets freeze. Money market funds can't meet redemptions. Commercial paper markets shut down, cutting off corporate access to short-term funding. Banks can't balance their books overnight. The entire system stops. Governments don't have the capacity to backstop $10 trillion to $12 trillion in frozen short-term markets. U.S. Federal debt already stands at $37.85 trillion, approximately 99.8% of GDP. The fiscal deficit in 2025 was $1.78 trillion. Interest payments on existing debt cost approximately $970 billion in 2025, roughly 17% of total federal spending. The government is borrowing just to pay interest on what it already owes. If the U.S. Treasury tried to issue another $2 trillion in emergency debt to fund a bailout facility, bond markets would revolt. Who's going to buy those bonds when the financial system is collapsing? Primary dealers can't take them down because they're already unable to finance their existing inventory in the repo market. Foreign buyers like China and Japan have been reducing their treasury holdings. The Fed would be forced to buy the bonds itself, which leads to the next problem. The Federal Reserve could theoretically print the money to backstop the repo market. They did it in 2008 and again in 2020 during the COVID panic. But that comes with severe consequences that are far worse this time. The Fed's balance sheet went from $4.2 trillion in early 2020 to $9 trillion by mid-2022, an increase of $4.8 trillion in just 2 years. That massive money printing contributed directly to the inflation surge that saw consumer prices increase over 20% cumulatively from 2020 to 2024. Trust in the dollar's purchasing power was damaged. Central bank credibility was shattered. If the Fed printed another $3 trillion to $5 trillion to backstop a repo crisis and broader banking system failure, inflation would return with devastating force. Markets would recognize that the Fed will always choose money printing over financial collapse, which destroys confidence in the dollar as a store of value. Long-term Treasury yields would spike as bondholders demanded protection from currency debasement. That would make the deficit crisis even worse as government borrowing costs exploded. There's also a political constraint. The 2008 bailouts created massive public anger that still reverberates today. Bank executives who destroyed the economy faced no criminal charges. Ordinary people lost their homes while banks got rescued. That political wound never healed. In 2025, trust in institutions is lower, polarization is higher, and the willingness to accept another massive bank bailout simply doesn't exist. Congress would face popular revolt if they attempted to pass TARP 2. Finally, there's a structural problem with bailing out repo market failures. You can't bail out a $4 trillion per day market where transactions happen continuously between thousands of counterparties. It's not like buying a bank's bad mortgage bonds and holding them on the Fed's balance sheet. Repo is overnight lending that has to be rolled over every 24 hours. To backstop it, the Fed would have to become the repo market, lending trillions every single night indefinitely. That would essentially nationalize short-term credit allocation in the United States. The practical and political barriers are insurmountable. When this breaks, there is no fix large enough. So here we are, sitting on top of a $4 trillion overnight repo market that's essential to the functioning of the entire financial system. A market that is roughly 30 times larger than the daily transaction volume that broke in September 2019. A market held together by $3 trillion in bank reserves that are still being drained at $25 billion per month through ongoing quantitative tightening. A market where the four largest banks control the majority of lending capacity and have just demonstrated they can't or won't lend to each other. A market facing continued Treasury issuance of over $7 trillion annually to finance massive government deficits. A market with seasonal stress points every quarter that have historically triggered crises. And a market with no credible bailout mechanism if it breaks because governments are too indebted, central banks have lost credibility, and the political will doesn't exist. On October 31st, 2025, banks borrowed $50.35 billion from the Fed's emergency standing repo facility in a single day. That was the highest usage since the facility opened in 2021. Days later, the New York Fed president held a secret emergency meeting with Wall Street banks. Those aren't signals of a healthy system. Those are warning lights flashing red. Jerome Powell and other Fed officials insist quantitative tightening can continue safely because reserves remain ample. They said the same thing in 2019, right up until the market seized and rates spiked to 10%. The response hasn't been to rebuild reserve buffers or slow the drainage. It's been to create standing facilities like the SRF as backstops and hope they're enough. They won't be. The crisis is coming. It might start with another seasonal liquidity squeeze in March 2026. It might begin with a Treasury auction that dealers can't finance. It might be triggered by a hedge fund failure or a bank that suddenly can't roll its short-term debt. The specific trigger almost doesn't matter because the system is so fragile that any shock will cascade through overnight lending markets into broader financial dysfunction within days. What comes after the repo market explodes is unknowable in detail but predictable in pattern. Bank funding freezes, credit stops flowing, money market funds suspend redemptions. The economic damage spreads from finance to the real economy within weeks. This isn't speculation. This is pattern recognition and basic mathematics. We're watching $50 billion in emergency borrowing during calm conditions. When actual stress arrives, everything breaks.